14 days. I mean, that is exactly how long it takes for the average amateur day trader to completely wipe out 2 whole years of compounding profit.
Yeah, which is just a staggering statistic when you really think about it.
Right. And, well, welcome to Bitcoin Deep Dives by MyCryptoParadise. I'm so glad you're here with us today because, we are opening up the playbook of one of the Paradise team's own all-star traders.
Simon.
Exactly, Simon. And the mission for this deep dive is to really explore the profound psychological difference between a professional trading mindset and, well, a gambling mentality.
Because, staring at lines on a chart only gives you half the equation, right?
Right, totally.
The other half, the half that actually determines whether you survive the next market cycle or, lose your entire portfolio, is entirely dictated by the invisible mechanisms happening inside your own head.
Yeah, and I want to speak directly to you, the listener, for a second. We know how brutal the crypto markets can feel. You have likely experienced the dizziness of that insane volatility firsthand.
Oh, absolutely. We all have.
But there is a reason that despite Bitcoin's massive historic runs, the vast majority of day traders just end up at zero. They fall victim to their own biology.
Human nature is a trader's worst enemy.
It really is. So in this deep dive, we are going to expose the structural traps that amateur signal groups build to give you false confidence. And we're going to reveal the uncomfortable, highly counterintuitive mechanics that the pros use to actually extract profit.
Which is where capital protection and relentless discipline actually build long-term generational wealth.
Exactly. That is the MyCryptoParadise core philosophy. Okay, let's unpack this. To understand how a professional maneuvers, we first have to tear down the illusion of the winning streak that is currently blinding retail traders in 2026.
Yeah, the current market structure is handing us basically a masterclass in this exact psychological trap right now.
Oh, for sure. Bring us into Simon's data.
So right now, Bitcoin is approaching a massive multi-time frame resistance at $76,000. And this isn't just like a psychological round number,
Right, it's not just a nice, neat figure.
Exactly. It is backed by the daily 1.272 Fibonacci retracement. And more importantly, there is a staggering $79 million whale sell wall parked directly below that level.
79 million, just sitting there.
Just sitting there waiting. But the sentiment data is where the trap really reveals itself. The daily fear and greed index is at a completely neutral 60.
Okay, 60.
Right.
Which seems fine.
Right, it seems totally fine. Yet if you zoom into the 1 hour time frame, it is flashing extreme greed above 80. Open interest is just exploding on over-leveraged long positions.
Wait, let me make sure I'm visualizing the mechanics of this correctly. We have a literal brick wall of selling pressure at $76,000, right?
Yep.
Yet the short-term momentum is incredibly aggressive retail buying, just regular people going long right into the wall.
What's fascinating here is the specific behavioral trap that a setup like this exploits. When extreme low time frame greed perfectly aligns with massive technical resistance, it means the retail masses are blindly buying into a ceiling.
Hoping it'll just magically shatter.
Exactly. They're hoping a resistance will just break on pure enthusiasm. But to understand the mechanics of why this is fatal, you have to look at the order book.
Right.
Think about it. If a whale holds $79 million worth of Bitcoin and they want to exit their position, they cannot simply hit market sell.
Because they'd crash the price on themselves.
Precisely. If they do that, they chew through all the limit buy orders on the books, trigger massive slippage, and completely ruin their own exit average.
So they literally require an army of overeager retail traders to absorb that massive bag.
Yeah.
They need people mashing the buy button so they can quietly distribute their holdings into that buying pressure without moving the market down. It's like walking into a casino where the house is actively handing you free drinks.
That's a perfect analogy.
They want you comfortable, they want you greedy, and they want you feeling invincible right before you sweep the table.
But 100%.
But this makes me wonder about the systems pushing people into this behavior. In the analysis we're unpacking today, Simon had a heavy critique of typical Telegram crypto signal groups.
Oh, yeah. Those groups are essentially liquidity farms for smart money.
Liquidity farms. That's such a brutal way to put it, but it's so true.
They manufacture false confidence through a mathematically doomed risk-to-reward structure. What they do is they'll issue a trade signal where the stop loss is placed incredibly far away from the entry price.
Right, giving it room to breathe, as they say.
Exactly. But the profit target is exceptionally close, so you win often, but the math is terrible.
Well, I have to push back here, or at least ask the logical question for the listener. If that structure is mathematically doomed,
Which it is.
Meaning one inevitable loss will wipe out 10 or 15 of those tiny wins. Why do thousands of people keep paying for those groups? I mean, are traders just inherently terrible at basic math?
It actually has nothing to do with math. It has everything to do with neurobiology.
Wait, really? Biology?
Yeah. Those tiny frequent wins hijack the brain's reward circuitry. Every time a trader hits one of those small targets, the brain releases a surge of endorphins and oxytocin.
Oh, wow. So they get a literal chemical high from closing a 1% profit?
Exactly. It creates this profound, visceral sense of safety and accomplishment. The brain literally rewires itself to prefer the immediate gratification of a 90% win rate, completely blinding the trader to the catastrophic risk exposure they're taking on.
So the trader feels like an absolute genius right up until the exact moment the market moves against them.
Yep. And when that inevitable stop loss finally hits, they don't just lose money. They lose their neurological supply of dopamine.
Oh, man. It's a withdrawal.
It is a chemical cutoff, and it triggers the amygdala, which is the fear center of the brain. The trader goes into a biological fight-or-flight response.
So they aren't even thinking logically anymore.
Not at all. This is the mechanism behind what we call the spiral of failure. They abandon their entire strategy, they start revenge trading, using even higher leverage to forcefully win back that lost capital and just, restore their dopamine baseline.
That is terrifying.
We have seen data showing traders who compounded profits steadily for 2 straight years, completely liquidating their entire portfolio in 14 days.
14 days. Just like we said at the start.
All because they entered that neurobiological spiral.
Wow. I never thought about it like that. So they aren't failing because they misread a moving average. They are failing because their biology was weaponized against them.
Spot on.
And because that amateur mindset is so deeply wired into human nature, it is highly predictable. Which, I guess, brings us to the second phase of this deep dive. If the market knows exactly how retail traders will behave, it actively hunts them.
It is a predator.
Right. So here's where it gets really interesting. Let's look at the liquidation heat map Simon pulled up.
The heat map is arguably the closest thing a professional has to X-ray vision into the market's underlying plumbing.
Yeah, and looking at the data right now, there are virtually no short positions left to liquidate above the current price.
Right, the upside is mostly empty.
Exactly. But right below the market, concentrated heavily at $70,000, there is this radioactive cluster of long liquidations. And that cluster sits just a fraction below the previous market low of $70,500.
This is a textbook example of how the market operates as a predator hunting herds. I mean, retail traders have a deep psychological need for neat, obvious safety nets.
They want things to look clean on the chart.
Yeah. They look at a chart, spot the last obvious bottom at $70,500, and tell themselves, well, okay, if it drops below that, the trend is broken. So thousands of them clump their stop losses in the exact same location.
Around $70,800 down to $70,000.
Exactly.
But why is the market actively drawn to that specific zone? Like, is there some algorithmic entity purposefully pushing the price down just to hurt retail traders? Let me see if I grasp the mechanics here.
It is entirely algorithmic, but it's not malicious. It is just a search for liquidity.
Okay, how so?
Well, remember, an exchange's matching engine is designed to pair buyers and sellers. Stop losses on long positions are, mechanically speaking, automated market sell orders.
Right.
If the price drifts down into that $7,800 zone, the first batch of stop losses triggers. Those market sells hit the order book, absorbing the buy liquidity, which instantly pushes the price down another $10.
And that downward tick triggers the next batch of stop losses.
Precisely. It's a cascading avalanche. One liquidation literally fuels the next.
So by placing their stop loss right below the obvious previous low, amateurs are essentially hiding from a storm in the exact spot where lightning strikes most often.
Yes.
Just because the rest of the herd is standing there.
They're standing in the most dangerous spot on the liquidity board because it feels psychologically safe to be with the crowd.
That is wild. So how does the Paradise team play this differently?
The professional tactic here is to analyze that heat map and place your stop loss deeply safely below that massive liquidation cluster.
Let the amateurs act as the buffer.
Exactly. Or if you are building a short position, use that exact liquidation cluster as your profit target. Let their forced selling automatically fill your take profit orders.
Let them do the work for you. That philosophy, defending capital 80% of the time, taking small paper cuts when you're wrong, and only turning aggressive when the probabilities heavily align, it feels like a completely different sport.
If we connect this to the bigger picture, what we are really talking about is adopting the operational mechanics of a hedge fund.
Right.
The reason retail day traders fail is that they are playing a short-term game of chance optimized for dopamine. A hedge fund plays a long-term game of risk management optimized for survival.
I want to make this concrete for the listener because we actually have a live example from the Paradise team.
Oh, the Ethereum trade.
Yes. Right now, the MyCryptoParadise VIPs are exploiting market moves using their WOVF trading tactic, capturing a 28% total profit on Ethereum.
It's a beautiful setup.
But the stark difference is in the execution. They used a strict 1x leverage and what Simon calls a double position size channel strategy.
Yeah.
For the listener who hasn't encountered this specific structure, how does this actually work mechanically compared to just mashing a 50x long position?
Well, the mechanism of a double position size channel strategy is fundamentally about hedging risk through predefined spatial zones.
Okay.
Instead of taking your entire capital and entering at one singular price point with high leverage.
Which exposes you to immediate liquidation if the market wicks down, obviously.
Exactly. Instead of doing that, you map out a specific channel of support and resistance. You enter with a conservative base position at 1x leverage.
Super safe.
Right. If the price drops to the lower bound of your channel, instead of panicking, your system automatically executes a double-sized allocation. This aggressively pulls your average entry price down toward the current market value, while the 1x leverage mathematically ensures you cannot be liquidated by sudden volatility spikes.
So you are mechanically designing a trade that absorbs volatility rather than being destroyed by it. You are trading time and positioning instead of just gambling on a direction.
Exactly.
That is an immense level of discipline compared to the 1-hour time frame over-leveraged chaos we discussed earlier.
And this discipline ties directly into a core structural reality of professional market cycles. It's called the exchange of hands.
The exchange of hands. Tell me about that.
If you study the brutal bear market drawdowns of 2012, 2015, 2019, 2022, 2023, and what we are analyzing right now in 2026, you will notice a mechanical pattern. Macro bottoms are never formed just because a chart indicator says the price is cheap.
How are they formed then? What is the actual catalyst on the exchange order books?
Bottoms are formed by capitulation by force.
By force.
Yes. During a prolonged bear market, massive over-leveraged entities like major Bitcoin mining operations or large institutional funds, they just burn through their cash reserves.
Because they have real-world expenses.
Exactly. Miners have physical utility bills, facility leases, and payrolls that must be settled in fiat currency. Eventually, they reach a mathematical breaking point where they are literally forced to market sell thousands of Bitcoin into an illiquid market just to keep the lights on.
Wow. So they aren't selling because their macro thesis changed. They're selling because their bank account dictates it.
And for them to dump thousands of Bitcoin onto the market, someone has to be on the other side of that transaction with massive capital reserves waiting to buy it.
Ah, the smart money.
That is the exchange of hands. The professionals keep their powder dry. They hold massive cash reserves specifically to deploy limit buy orders deep in the order book, just waiting for the exact moment the over-leveraged entities are forced to liquidate.
There's a brilliant analogy Simon used to describe this dynamic. Professional trading is honestly boring, and it is highly uncomfortable in the short term. It's exactly like taking a daily cold plunge or strictly eating healthy.
It really is.
I mean, eating a bowl of vegetables doesn't give you that quick dopamine sugar high that gambling or eating junk food provides, but it is the only verifiable biological mechanism that guarantees long-term survival.
And that is the hardest psychological chasm for a retail trader to cross. You have to actively reprogram your brain's reward center to find deep satisfaction in the boring, flawless execution of a risk management system rather than the chaotic thrill of a high-leverage bet.
Which speaks directly to how MyCryptoParadise structures its operations. I mean, the transition to a full hedge fund model involves multiple all-star traders independently probing the market with diverse tactical strategies.
Yeah, but they don't just run wild.
No, exactly. The keystone of the entire operation is the risk management leader. That leader's singular mandate is to calculate the worst-case scenario first. Before anyone even discusses potential profit, the risk exposure is stress-tested.
That structural firewall is brilliant because it mathematically neutralizes the emotional blind spots of the individual traders.
It takes the ego out of it.
Completely. When your operational protocol forces you to define the absolute worst-case scenario and size your positions to survive it, you completely insulate yourself from the neurobiological trap of greed. Risk always precedes profit.
Okay, let's apply all of this high-level psychology and structural mechanics to the realities of Bitcoin charts today. What is the ultimate plan? And more importantly, how does a professional react if their deep conviction turns out to be wrong?
Well, Simon mapped out two distinct paths right now.
Let's start with Plan A.
Plan A is a severe macro crash down into the $44,000 to $55,000 zone, perfectly aligning with the 6169 Fibonacci retracement level. This is viewed as the final exhale of the bear market cycle.
That final capitulation by force we just talked about.
Exactly, before Bitcoin ultimately targets the massive $169,000 resistance.
Okay, and we also have to map the invalidation of that thesis. Plan B.
Right. Plan B is that Bitcoin manages to clear that massive $76,000 resistance, pushing through that $79 million sell wall in a confirmed five-wave structure and literally flipping that heavy ceiling into a bedrock of support.
Now, the analysis we are reviewing has carried a strong conviction for that $44,000 drop for quite some time. And Simon used this beautiful philosophical analogy. Wire is the strongest element on Earth because it doesn't fight a stone. It flows around it. It adapts instantly to its environment.
It's a great mindset.
It is, but I have to challenge the practical application of this. How does a human trader actually be water? If you have spent months publicly and privately building a massive macro thesis that the market is going to crash to $44,000, how do you practically turn off your ego when the market does the opposite?
That is the million-dollar question. It raises an important point about the actual mechanics of detachment. You cannot rely on sheer willpower to turn off your ego in the heat of the moment.
Because your biology will override you.
Exactly. Human biology will always win. To be water, you must rely on rigid, predefined systems. You set algorithmic triggers and strict conditional rules.
Give me an example of that.
So for example, if the daily candle closes fully above $76,000 with corresponding volume, the short thesis is mathematically invalidated. When that trigger hits, a professional does not sit at their screen trying to justify holding the losing position.
They don't start moving their stop loss around.
Never. They close the laptop, they let the system execute the stop loss, they physically step away to let their neurochemistry reset.
So detachment isn't some mystical state of mind. It is an operational protocol.
Exactly. The market breathes. It breathes in impulses, the inhales, and it breathes in corrections, the exhales. A professional fundamentally understands that they are a very small fish swimming in an ocean filled with financial leviathans.
Right.
You do not stubbornly fight institutions wielding billions of dollars or proprietary algorithms.
Because if you try to stand in front of that freight train, just because your ego demands you be right, you will be atomized.
Which is why, if Plan B happens, if Bitcoin rips through $76,000 and the bears mathematically lose their strength, a professional won't sit there blindly shorting the market.
And crucially, they won't succumb to FOMO and immediately mash the market buy button at the top of a massive green candle either.
No, they will wait. They will watch the order book structure confirm that the previous resistance is now acting as support. They calmly admit the bears lost the battle, and they reposition their capital to align with the bulls. Total detachment from the need to be right is the ultimate hallmark of mastery.
So what does this all mean for you listening right now? It means that the core lesson from Simon and the MyCryptoParadise team is this. The secret to long-term generational wealth in the crypto space isn't finding a magical, perfectly calibrated technical indicator.
Not at all.
It isn't catching the absolute bottom tick of a wick. It is entirely about mastering your own biological impulses. It is actively choosing the uncomfortable cold plunge of strict, systematic discipline over the temporary sugar high of an over-leveraged, dopamine-fueled position.
It demands a fundamental rewiring of how you evaluate your own success. I mean, a successful day in the market isn't defined by making a 100% return on a lucky gamble.
Right.
A successful day is defined by flawlessly executing your risk management parameters, protecting your capital, and surviving to trade another session, regardless of whether the specific trade was a win or a loss.
Thinking in probabilities, not emotions. Respecting capital protection above absolutely everything else. Treating your inevitable losses not as a personal failure or some kind of assault on your ego, but strictly as data, just mathematical feedback that sharpens your edge for the next setup.
Let the massive wins be the natural, inevitable byproduct of disciplined execution.
Exactly. Detach from the immediate outcome. When you adopt that specific mindset, you aren't just clicking buttons on an exchange. You are trading alongside the best, deeply embedded in the MyCryptoParadise family philosophy.
I want to leave you with a final thought to mull over today. We spent significant time unpacking how extreme, low time frame greed provides the necessary liquidity for massive whales to distribute their holdings.
The casino trap.
Right. The mechanics of the market require eager buyers to absorb institutional selling. So, the next time you are staring at a chart and the candles are pumping vertical green, and you feel that overwhelming, urgent biological urge to hit the buy button before you miss out on the wealth of a lifetime.
We've all felt it.
Take a breath, look at the order book, and ask yourself a simple question. Whose bags are you buying right now? In this exact moment, are you the predator navigating the depths? Or are you the prey providing the liquidity?